This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This lecture is on Chapter 18 of the Paper F5 lecture notes, and it's on transfer pricing. And this relates to divisionalisation. In the last lecture, I explained what we meant by divisionalising, and the idea that each division operated as though it was a separate company, so that we could make them profit accountable. But one problem we can have is when you've got one division supplying goods or services to another division. And in that sort of situation, if we want to make them profit accountable, we really need to allow the division transferring to the other division, we need to allow them to charge for what they're transferring. You know, you could have a factory in one city, a division, part of our company, a factory producing goods. Maybe they send the goods to another city where we've got the shop, where we're selling the goods. Well, as I'm about to hopefully explain with a tiny example, if we want both divisions to be profit accountable, we need to let one division charge the other, and that's the transfer price. The transfer price is the price charged by one division for goods or services supplied to another division. Now, rather than keep talking, let me show you with a tiny example to start us off exactly what I mean and why we bother. Look at example 1. Division A produces goods and transfers them to Division B, which packs and sells them to outside customers. So I always like to draw a little picture. I mean, later when it gets a bit more complicated, this can be useful. But we've got Division A, which is actually manufacturing the goods. They then send the goods to Division B, which packs them, and they do the selling. They then sell externally. We're told the costs. Division A has costs of $10 per unit. Division B, they're doing the packing, so they have extra costs, another $4 a unit. And then they're sold to external customers for $20. Now, ignoring the next line for the moment, A says, what's the total profit made by the company overall? Because remember, there is only one company, even though we've two separate divisions. And so as far as the company as a whole is concerned, if we look on a per unit basis, there's a selling price of 20. The costs, again, there is only one company, but in Division A we're incurring costs of 10, B costs of 4, so the total costs are 14. And therefore, as far as the company is concerned, we're making a profit of $6 per unit. However, I want to make the divisions profit accountable, and of course, as things stand, A has got the majority of the costs and no direct revenue. B, as things stand, has very little cost and has huge revenue. And so it's hardly fair or motivating on Division A. And so, to be able to make them profit accountable, we let Division A charge Division B for the goods they transfer. And that line I jumped over, it says, assuming a transfer price of $12 per unit, calculate the profit made by each division. Now we'll discuss afterwards how we might arrive at this transfer price. That's what the bulk of this chapter is about. But for whatever reason, it says that A is charging B $12 a unit. So let's look the profit each division separately will report. A is effectively selling goods to the other division for $12, so their revenue is the transfer price. And their costs, the costs in division A, they'll report costs of 10, and so they'll report a profit of $2 a unit. As far as division B is concerned, when they produce their own profit statement, they're getting revenue, the selling price of, what was it, 20? As far as the costs are concerned, well, effectively, they're buying from division A, so the transfer price, 12, and in addition, they've got their own costs, because they then have the costs of packing them. The additional costs are 4. So they're reporting costs of 16, and therefore that division will report a profit of $4. And so see what's happening. Of course, in total, the profit is $6. We already knew the company's making $6. And that transfer price, it's effectively a receipt for one division, it's a cost for the other division. It disappears when we put the whole company together. The transfer price simply splits the profit between the divisions so that, yet again, we can make them profit accountable. Individually, division A, we're after bigger profits. Division B, their job is to make bigger profits. It's simply splitting the total profit. That's all. Now, before I go any further, I must say, because some of you will be aware, that one reason for transfer pricing often in real life is where you've got divisions or subsidiaries in different countries. And although there are rules to try and stop this, by having one country's division sell to another country's, you can move where the profits are, and ideally you'd want to get the profits in a country with the lowest tax. Well, although in real life that can be a factor, in paper F5 that's not relevant. The divisions are in the same country. Tax is irrelevant. The transfer price is purely to be able to make each division profit accountable. So that's why we have a transfer price. The question is, how do we go about deciding? Is the transfer price $12? Is the transfer price $14? Why? Well, over the page, a very common way of deciding on a transfer price in real life is cost plus transfer pricing. Now, you've heard of cost plus in ordinary pricing in the pricing lectures earlier, but it's very common in transfer pricing. And so look at example 2. Check out how it works, and then we can discuss whether in fact it's sensible. But in example 2, again we've got division A, which has costs of 15 a unit. They're transferring goods to division B. They've got these extra costs of $5 a unit, and division B is selling externally at 30 a unit. So exactly the same as the previous one, with, I hope, yes, different numbers. And ignore the transfer price for the moment. I'm going to do the requirements in a different order. Part B says, what's the profit for the company as a whole? And remember, there is only one company. In fact, it's divisionalised, in that sense it's irrelevant. For the company as a whole, the selling price is 30. The costs in one division are 15, in another division 5, so in total 20. And so, for the company as a whole, there's no question. There's a profit of $10 a unit. However, if we're divisionalised, if we want to make the division's profit accountable, we need this transfer price. And in this question it says, if you look back, the company has a policy of setting transfer prices at cost plus 20%. So part A, what is the transfer price? Well, it's division A who's doing the transferring. It's A that's selling to B. And so when division A does the transferring, they take the cost. Well, the costs in division A are 15. And it says we have a policy of adding on 20%. 20% of 15 is 3. And so the transfer price is 18. Now we've got a transfer price. We can do part C and see how much profit each division separately reports, again on a per unit basis. As far as A is concerned, as far as they effectively are selling to B at 18, so the transfer price is their revenue. The costs in division A are 15. And so they're reporting a profit of $3 a unit. What about division B? They're selling externally at a selling price of 30. Their costs, well, they're buying it from division A, so the transfer price they're having to pay 18. In addition, they've got their own costs of 5. So they'll report costs of 23 and therefore a profit for that division of 7. And so again, all the transfer price does is split the profit between the divisions. In total, the company's making a profit of $10, and of course we knew that from part A. Whatever the transfer price is, the total profit's 10, the transfer price just determines how it's split. Now, cost plus is a common way in real life of determining a transfer price, because we can have a standard company policy. You know, there might be lots of different products that are being produced and passed between different divisions. It's useful in that situation to have a standard company policy that anything you produce and send to another division automatically throughout the whole company take cost plus 20% or whatever percent we've decided on. However, although it's nice to have a standard policy, and although it makes life that much easier if we've lots of products and lots of divisions, there are two big problems here. Problems with cost plus. One of them, I think, should be fairly obvious. That why are we making the division's profit accountable? So that the managers of each division can be motivated to increase the profitability. You know, we looked at different ways of measuring, but ultimately we want each divisional manager to be motivated to make more profit. And, you know, B, how are they going to make more profit? Oh, B, maybe we can charge a higher selling price, maybe they can cut costs, fine. We want them to cut costs and make more profit. But look at division A. How can A make more profit? The transfer price has been fixed at 18, so they can't suddenly say, let's put the price up. It's been fixed. And incidentally, putting the price up to 19 wouldn't give more profit to the group company as a whole. You know, transfer price 19 would give more profit to A and less to B. It wouldn't help the whole company. Division A can't sell more goods because they're reliant on Division B. You know, they only produce what Division B wants, sort of thing. All right, we want them to cut costs. But think about it. If A cuts costs, if they manage to get the cost down to, say, $10 a unit, which is great for the company as a whole, with this policy of charging cost plus 20%, They add on 20%, $2 profit, they make less profit. There's no incentive at all for A to cut costs. The only way A can make more profit is to actually increase costs. If their costs go up to 16, they'll add on 20% and make 320 profit. But that's mad. We want A to have the incentive to cut costs, and yet again, if they cut the costs, they make less profit. We're actually motivating them to increase costs. And so that's the first reason why cost plus is actually not perhaps such a good idea. Division A is not motivated to cut costs. We're actually encouraging them, in a sense, to increase costs. It's the only way they can make more profit and be rewarded for it. But there's another problem as well, which for what follows in the chapter, and what you really tested on in Transfer Pricing at F5, is it can lead to decisions that are not goal congruent. Now, I did mention the words goal congruent in the lecture on divisionalisation. It means same aim. And as I'm about to illustrate with the third example, we can end up in the situation, if we're not careful, where the managers end up making decisions that are actually not good for the company as a whole. And let me show you what I mean with example 3. Exactly the same sort of problem. We've got division A with costs of 20 a unit, transferring goods to division B with costs of $8 a unit, and division B is selling externally at, what is it, 30 a unit. And again, I'll do the requirements in a different order. First of all, B, how much profit is the company as a whole making? And for that, divisionising transfer price is irrelevant. For the company as a whole, selling price is 30. For the company as a whole, the costs in A are 20, in B are 8. The company is making a profit of $2. Before we carry on, is this product worth making for the company? Of course it is. We always assume there are lots of different products being made. This is just one of them. And as far as the company as a whole is concerned, if a particular product is profitable, it's worth making. Obviously, if it's not profitable, it's not worth making. So the company wants this product. Oh dear, I'm writing too fast here. The company wants to produce the product. As I said, we always assume there are lots of different products being made. We're only looking at one of them. This product's profitable for the company wants it. However, we are divisionalised, and so it's up to each manager to make their own decisions. And so let's do part A. Let's decide what the transfer price is. Like the previous one, the company has a policy of setting prices at cost plus 20%. It's A who's doing the transferring, the selling to the other division. A has costs of 20 per unit. They're told to add on 20%. Of 20 is 4. And so the transfer price, 24 a unit. And so now let's look at how the profit's split between the divisions. A is effectively selling at the transfer price, which is 24. A's got costs of 20. A reports a profit of $4 a unit. What about B? B is selling at a selling price of 30. The costs they'll report, well, they're having to buy the goods effectively from A at the transfer price of 24. They've then got their own costs of finishing the goods, of packing them, of 8. So in total costs of 32 a unit. They'll report a loss of $2. And so again, all the transfer price does is split the profit between the divisions. In total, one division makes a profit of 4, one makes a loss of 2. The total profit for the company is $2, which we already knew. As I've kept on saying, transfer price simply splits it between them. But we've now got a problem. Because remember, if we divisionalised, we've given the managers autonomy to make their own decisions. And what's going to happen? Division A, remember we always assume there are lots of other products as well. But as far as this product's concerned, Division A is more than happy to produce and sell it to B because they're making a profit. But it's Division B that's the problem. As far as Division B is concerned, this product is loss-making. And you know, if they're being measured in some form or another on the profits of their division, why on earth are they going to make a loss-making product, or a product that's loss-making for them? And B's not going to deal in that product at all. It's ridiculous. Why should they carry on making losses on something when their objective is to make more profits for their division? Now again, it doesn't mean that B would close down, because I keep saying we always assume we're making lots of other products as well. But Division B, all right, any other products that are profitable, fine, but this product is loss-making. And if we allow them autonomy, Division B will not deal in this product. And so, of course, if Division B refuses to buy and sell it, Division A won't produce it if B's not buying it. And so the end result is the company loses a profitable product. And that is the potential problem if we're not careful about the transfer price. We already knew for the company as a whole, there's a profit of $2. And so the company wants this produced. But it's when we leave the decisions up to the managers that if either of the divisions, if the transfer price is such that either of the divisions report a loss, that division will refuse to deal in it. And in that example there, we end up losing, the company ends up losing a product that they actually want to produce. And how are we going to deal with it? I mean, there are two choices. One is just to tell the divisional managers, you must deal with this product. But that's not going to be very motivating. I don't think manager of Division B is going to be too happy. On the one hand, you tell him he's got autonomy and he can make his own decisions, you know, to motivate him to do better. But now we're telling him, you've no choice. You're forced to make what for you is a loss-making product. So I say it's not very motivating. The alternative is to make sure we fix what you might call a sensible transfer price. A transfer price that does motivate both managers to want to do what's good for the company. I hope I've explained enough there that a transfer price of 24 will not achieve the desired result. What company wants the product? Transfer price of 24 ends up with us not producing it. We need to make sure that the transfer price we end up with, again, will motivate both managers to do what's good for the company as a whole. At the moment, it's not goal congruent in that Division B is making a decision which is good for him, his division, but it's not good for the company. And so the rest of this chapter, and I'm going to pause here, but in the next lecture, we're going to look at how we should go about fixing a sensible transfer price that removes that problem. So we'll stop this lecture here. The next lecture I'll go through a series of little examples as to how we do sensible transfer pricing.